Good morning and welcome to today's webcast, How Tax Reform Impacts Hospitals and Health Systems. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Chris Bell, Partner, and Colleen Ramires, Senior Manager. Chris leads the firm's healthcare tax practice and has been in public accounting since 2005. His sole focus is providing tax and business planning services to healthcare entities throughout California. Prior to his career in public accounting, he managed a medical practice. He is a frequent speaker and author on tax reform, the Affordable Care Act, as well as transaction planning in healthcare. Colleen began her career in public accounting in 2004. She works with several not-for-profit entities, including public hospitals, healthcare organizations, and foundations. Her experience includes tax planning, tax return compliance, and consulting in areas such as the Affordable Care Act, unrelated business income, and employee benefits. Within the firm, she is frequently tapped as a technical and review resource within the tax-exempt space. And Chris, I'll turn the line over to you to get us started.
All right. Thank you, Emily, and thank you to everyone who's participating. To begin with, we would like to provide a brief overview of how we got here with tax reform before we delve into 2 main sections. We would like to cover how tax reform will impact tax-exempt healthcare entities, but also spend some time focusing on some of the for-profit healthcare entity issues, which in our experience tend to apply to most healthcare organizations through joint ventures and partnerships. And so to get started, we'd like to walk through how the tax reform bill was passed. Originally, it was introduced in November after some closed-door negotiations between key Senate and House leaders. The House passed its bill in early November. The Senate passed its bill in December. And then there was a conference agreement, and it was signed by the President on December 22nd. The reason why this is important, just as a quick reminder, is there are several issues with the law whereby it was passed quickly and there were errors that went undetected until after it was signed into law. And so we're going to discuss a few of those and how they impact your organizations. The goal of of tax reform was to reform the tax code to make it simpler for most filers. In terms of the quantity of filers, it may have reached this objective. For most individual taxpayers, filing their tax returns is simpler as a result of this law, at least for a few years. However, for most business entities, including everyone on this line, filing has become more complicated, and so this is not universally felt. It's projected to increase the deficit by $1.5 trillion. Now, the Republican leadership doesn't agree with that number. That's the Congressional Budget Office estimate, but it is expected to increase the deficit. It's intended to improve our international competitiveness, to spur economic growth, and we're seeing some of that economic growth. It's also intended to bring parity for certain large tax-exempt organizations with how publicly traded corporations are treated, and we'll talk about a number of those provisions as we go through our day. This brings us to our first polling question. Emily?
All right, thank you. And our first polling question, please select the sentence that best describes your organization. Are you a for-profit taxable entity, tax-exempt entity, but you have significant for-profit joint ventures and partnerships? You are a tax-exempt entity, but have some for-profit joint ventures and partnerships? You're a tax-exempt entity without for-profit ventures, or none of the above. And I'll give everyone a few moments to make a selection. To participate, please click the button next to the answer you choose and hit submit. And we did have an error with the PDF in today's presentation slides. If you're not seeing the right slide deck in there, just refresh your browser and that should be updated. We'll also be sending a copy to everyone who is on the webcast today. And let's take a look at the results. Chris, back to you.
All right, so that's interesting. I think our winner is that we have most of the participants on the call are tax exempt with some for-profit joint ventures, but we also have some for-profit only taxable entities on the line as well. So we'll make sure we customize our comments to those groups. So with that, when we talk about changes to how tax-exempt healthcare organizations will be impacted by tax reform, the first issue is the individual mandate. The Affordable Care Act assessed a penalty, or I think they called it a shared responsibility payment, against individuals who, according to the law, ought to be able to afford health care insurance but chose not to be insured. This penalty was repealed beginning in 2019. The Congressional Budget Office estimates it will result in 13 million more uninsured individuals in the healthcare system and a 10% premium increase independent of other forms of healthcare cost inflation. The largest impact for individuals on this call, we believe, will be the impact to uncompensated care, as well as the strain and pressure on the overall healthcare system as a result of employers and individuals pushing back on premium increases and looking for greater efficiencies in the healthcare system. With that, I'm going to turn it over to Colleen to talk about how compensation will be changed under tax reform.
Thank you, Chris. Going back to the individual mandate just for 1 minute, this could have an impact on the code section 501R. The IRS is already looking at 501R. There's been several exams that have come out in the last year or so. Their intention is to continue to look at 501R. So there may be additional attention just regarding making sure that uninsured individuals that would qualify under financial assistance are actually being covered. Also, it helps support the tax exemption for many hospitals because of the increase in the care for those that do not have insurance. So like Chris mentioned, the tax law changes are very widespread, and they even affect tax-exempt organizations in a couple significant ways. The first way is with compensation. So there's now a 21% excise tax. It's due from the tax-exempt organization. So it's not on the employee. It's paid by the organization. It's on covered employees that are paid in excess of $1 million. This relates to the filing organization and the related organization. So you're not able to pay half out of one and half out of the other. They look at it combined. And then also outside of the $1 million, any excess parachute payments that are paid to those covered employees. Kind of quickly just going over parachute payments, it means that it's a payment where the nature of the compensation is contingent on the employee's separation from employment, and the aggregate present value of the payments equals or exceeds an amount that's 3 times equal or equal to 3 times the base amount. The base amount is the average annual compensation for the 5 most recent taxable years. One caveat to this is that if you can show that the payment relates to services that are performed after the change in ownership, that would not be included under the parachute payment. Also excluded from this excise tax is compensation paid to a licensed medical professional when services are directly related to the performance of medical or veterinary services. I do want to just highlight that last section. If you have a licensed medical professional and they're serving in the capacity of a CEO or CFO and they're performing officer duties, they're not going to be excluded under this because you have to be performing medical services. So this more relates to the physicians that are working in the hospital.
So Colleen,
for a covered employee, it's a current, did you want to jump in, Chris?
Real quickly, one thing to consider is for physician leaders in healthcare organizations, their contracts may indicate they have both clinical and administrative responsibilities, but their compensation may not be clearly delineated as to which part is for administrative work and which part is for clinical work. On a go-forward basis, it may be helpful to document that in the employment agreements with those employees to make it easier to justify with the IRS the position the organization is taking, so they can exempt some of that income from this 21% excise tax.
That's a great comment. Thank you, Chris. So for a covered employee, it's a current or former employee if they're one of the 5 highest compensated employees for the tax year. And with that, that's going to be different than the 5 highest compensated employees you're reporting on your 990. For this purpose, you're looking at your CEO, your CFO, any of your other top officers, any key employees. Generally, your 5 highest compensated employees of the 990 are physicians, so it's different than the terminology for your 990. And this is kind of a bigger deal, is it's when somebody becomes a covered employee, they're always going to be a covered employee. So it will require the organization to do some tracking to make sure that they have a list of anybody that would be considered. And you do have to look at 2017, tax year starting after 12/31/2016, to see if somebody is a covered member. One important note with this, watch out for 457F, non-qualified deferred compensation benefits in the year of vesting, and then the severance payments, because those relate to the parachute payments. With the 457F payments, when they vest, they're fully taxable in that year, and so that could, and they're included in taxable compensation, so that could put you over the $1 million excess. So it's just something to look at and consider. This excise tax on compensation, it applies to the following tax-exempt organizations. I'm not going to go through all of them. 2 that I did want to touch on is those exempt under 501A, and please ignore the 1, that shouldn't be there. Those are corporations organized under an act of Congress, which is within an instrumentality of the United States. The other one I want to highlight is organizations exempt under Section 115 as exercising essential government functions of a state or political subdivision thereof. What this means is that organizations that generally they don't have to file 990s, they're not usually having to deal with tax or unrelated business income, this is going to apply. And there are some organizations where this has been kind of a surprise for them. With that, we will go into our second polling question.
All right. With the new excise tax on compensation, will your organization look at restructuring non-qualified deferred compensation plans, look at restructuring severance or change of control agreements, all of the above, or none of the above? And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We are on our second polling question of the day today. I'll give everyone a few more moments here to make a selection. And let's take a look at the results. Colleen, back to you.
Okay, so it looks like most of you are not looking at restructuring. I would assume that means that you guys are just planning for when the vesting may happen, or that the change of control payments are likely not going to be 3 times the average 5-year compensation. So this is something to look at, though, with the non-qualified deferred compensation plans. You may want to look at if you could possibly do a rolling vesting so it's not all hitting in 1 year. So just possible planning opportunity. Also, we'll just kind of touch on this. There are some fringe changes with fringe benefits with employee achievement awards. Generally, if those are tangible personal property that you're providing, they're non-taxable. There wasn't really a good definition of what non-taxable or what tangible personal property was, so they clarified that. Also, moving expenses are now all considered taxable compensation to the employee. So there's no qualified moving expenses that are a non-taxable fringe benefit. And then bicycle commuting, if you happen to have that, it's a $20 per month excluded from wages. That's been repealed, so that's now included in employee wages as well. Moving on to unrelated business income, this is another big section that the tax law reform affected. We'll go into more details on these and is what was changed under unrelated business income. So the first we went over the fringe benefits that changed that are more related to compensation. These are fringe benefits that are now going to be treated as unrelated business taxable income. So those are any amounts that are paid for any qualified transportation fringe benefits. A common one with this is if you're paying transit passes, that's going to be considered unrelated business income now. Any parking facility used in connection with qualified parking is also going to be considered. And then any on-premise athletic facility. Going back to the qualified parking, that means any parking that's provided to an employee on or near the business premises of the employer or on a location that's near from which the employee commutes to work by transportation, such as in a commuter highway vehicle or by carpool. We are waiting for regulations on this. It specifically states in the tax law change that the IRS will issue regulations stating what they consider to be the amount that should be included under parking facility as unrelated business income. There's a lot of question of, will I have a parking lot? Patients park there, employees park there, there's no cost for them to park anywhere else. What really is the value of that benefit that we're providing to employees? And unfortunately right now, as Chris mentioned, this was kind of hurriedly passed through, so we don't have definite support of what that is going to be. Of these, any of these benefits that are directly offsetting another unrelated business activity, they're not treated as unrelated business income. It's just treated as a non-taxable expense. So you essentially can't deduct it from the income of the other unrelated business income. Also, if you're treating any of these as taxable compensation to your employees, then that would also be excluded from unrelated business income. Excuse me. So this is for any amounts paid or incurred after December 31st, 2017. There is a possibility that any of you on a fiscal year end may have to account for that for the portion of the year after 12/31/2017. Again, we're waiting for more specification, guidance, and clarification on these. One of the big impacts with UBI is activity bucketing. So in the past, if you had several different activities, one had income, one had losses, you could combine those and offset the income with the losses. Starting in 2018 and going forward, that is no longer allowed. So you have to separately calculate each unrelated business income. So essentially, it prohibits using deductions for one activity against another activity. There is a special transition rule for NOLs that are arising in years before January 1st, 2018, and we'll get into that in more detail later when we cover the change to net operating loss carry-forwards and carrybacks. So how this will work is you will calculate unrelated business taxable income for each activity. And then the UBI cannot be less than 0. If it's less and has NOL, you can carry it forward. And then there's a specific deduction of $1,000, and that's going to be applied towards each activity. And again, this is effective for tax years beginning after December 31st, 2017. So here's a quick example of the activity bucketing. So we've got these different activities that are considered unrelated business activities. You see some have income, some have losses. The total of all of those is an overall loss of $165,000. So in the past, there'd be no tax due because it would be applicable on that loss. Starting in 2018, the tax is due because you're looking at the web advertising, the printing services, and the disallowed fringe benefits, and those are taxable because you can't offset the loss from that. This is just a summary of the fringe benefits that we went over. It just kind of nicely shows pre-reform law and after the Reform Act. And we will go into our third polling questions.
All right. Which fringe benefits do you currently offer in your organization? You can select all that apply. Moving expense reimbursements, on-site cafeteria, on-site gym, parking and/or transportation benefits, use of box seats at sporting events and/or concerts, or none of the above. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. And as I mentioned earlier, we'll be emailing these slides after the webcast. And I'll give everyone a couple more moments to make their selections, and we'll take a look at the results. Colleen, back to you.
Okay, so a lot of you provide parking or transit benefits, so that's probably going to be a big impact. You're probably also frustrated with the fact that we don't have better guidance on parking. Moving expense reimbursements, I've heard from a lot of clients that that is also a big one. With that, there's a little bit of relief there that you're not going to have to track, qualified versus unqualified. So moving
Colleen,
on
one thing real quickly on the moving expense, since it's used as a recruiting tool for highly compensated employees, including clinicians, there's no transitional relief for moving expenses you agreed to pay for an employee previous to tax reform, but wasn't actually reimbursed or paid to the employee until 2018. And so that will become part of their taxable compensation, even if you originally agreed to that benefit previously in 2017. Something to keep in mind.
Definitely, yes. So as I mentioned earlier, there's changes to net operating loss carryforwards. This applies to tax-exempt organizations and for-profit organizations. So beginning after December 31st, 2017, net operating loss carryforwards are limited to 80% of taxable income. They did change the carryforward period from 20 years to indefinite. However, they removed the carryback period from 2 years to you can't carry it back at all. This does make it harder for C corporations and tax-exempt organizations with unrelated business income to completely zero out their taxable income each year. With that, any NOLs that are generated in 2017 and earlier, the old rules will continue to apply. So you can offset 100% and it's carry forward 20 and carried back 2. So you want to look at what are your NOLs from 2017 and prior and what are your NOLs from 2018 and going forward. What for unrelated business income, another thing that's going to need to get considered is for NOLs that are generated in 2018, those also are subject to the bucketing rule. So if you have an activity that generates a loss, you can only apply that to that activity in future years. You can't use that against other activities. However, similar to before with the 2017 losses and 2017 and earlier losses, you can apply those towards anything going forward. So you still get that same treatment, and that may help provide some relief. If you have NOLs, that'll help provide some relief before that bucketing will kick in and affect you. With a net operating loss, it's a little bit tricky for fiscal year ends. So for fiscal years that are ending before January 1st, 2018, the old rules apply. For those that are ending after 12/31/2017, there's a transition rule. It's essentially kind of a hybrid NOL between the 17 and pre-rules in 2018 and going forward. So there's no carryback. There's an indefinite carryover as is in the 2018 rules. However, you're still allowed to offset 100% of taxable income in the year used, and there's no, it's not subject to the bucketing. Then for fiscal years beginning after 12/31/2017, you're following the new NOL carryover and carryback rules. So the U.S. Corporate tax rate did change. It's been reduced from 35% to a flat 21% for tax years beginning after December 31st, 2017. That 35%, I do want to say that is the rate, that was the rate for the highest income tax bracket. I believe the highest rate was actually 39%. For fiscal year filers, you'll use a blended tax rate, so you're going to look at what your tax rate would have been for the time period up until 12/31/2017, and then after that, you're going to use the flat 21%, and you're going to do a blended rate of those two, and this is an example using the 35% rate. Also, the alternative minimum tax has been eliminated for corporations, and so that also applies to tax-exempt organizations with unrelated business income. So effects on charitable giving, the increase in the standard deductions for individuals, they're estimating that about 95% of taxpayers will not itemize, so that could have an effect on charitable giving. They also doubled the estate and gift tax exemptions and the generation skipping transfer tax exclusion. One other thing they did address that I'll point out is for those that will still be itemizing, the AGI limit for charitable contributions went from 50% to 60%. So those who are itemizing will be able to take a larger deduction for their charitable contributions. Touching on this really quickly, tax-exempt bonds, the tax exemption for advanced refunding bonds has been repealed for bonds issued after December 31st, 2017. This doesn't apply to current refunding bonds. Those are still considered tax-exempt. And then the authority to issue tax credit bonds and direct pay bonds is repealed for bonds issued after December 31st, 2017. I'm not going to go into much more detail about that. If you have questions on that, feel free to reach out to us. Also feel free to reach out to your bond counsel. And then I did want to just touch briefly on some of the international changes. Again, I'm not going to go into too much detail. This may not apply to quite a bit of you on the call, but it's a significant change, so I wanted to make sure to mention it. So there is a fundamental change to how the United States is now taxing U.S.-based corporations that have operations and activities outside of the U.S. Effectively, it moves to a modified territorial tax system rather than a worldwide tax system that existed under the prior law. Under a territorial system, essentially, a U.S. company is only taxed on the U.S. income of a corporation and would be exempt from all foreign income. Like I mentioned, it's modified, so it's not that straightforward. Tax laws aren't ever that straightforward. The stated goal is to encourage businesses to locate operations in the United States, to discourage offshoring, and to try and make it a little bit more competitive with what other countries have for their tax laws. How this is going to impact tax-exempt organizations, it's still to be determined. We're still watching that. But some key takeaways, just wanted to highlight the second bullet point under the first one. The IRS has ruled that Subpart F incomes generally considered to be deemed a dividend. Generally, dividends are tax-exempt to organizations. However, if it's considered a UBI, considered unrelated business income, which some dividends can sometimes, then it could have an effect. If you have alternative investments or if you have related foundations that have endowments and have alternative investments, we can see possibly an influx of income and additional disclosures that are going to be reported on K-1s, and it could reduce the availability of foreign tax credits. It's also going to likely make the foreign tax filings get more complex just because there's going to be more reporting required. So just be aware of that. If you have international activities, if you have alternative investments, I do know we have an international webcast that we did that's on our website, or also feel free to reach out to us and we can get your questions answered. And with that, we will move on to the fourth polling question.
Okay, our final polling question. What tax law changes will have the biggest impact on your organization? Excise tax on compensation, changes to UBI, including bucketed and changes to NOL, taxable fringe benefits, international tax law changes, or other. Give everyone a few moments to make a selection. And once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. I'll give everyone a few more moments here, and let's take a look at the results. Colleen, back to you.
Thank you, Emily. So yeah, taxable fringe benefits, that's what we're hearing a lot, is that's going to have an effect. Excise tax on compensation, and then the UBI bucketing, those are those are exactly tied. So yeah, these are the three major areas that are affecting tax-exempt organizations. And with that, I'm going to turn it over to Chris to go over business provisions.
Thank you, Colleen. As a reminder, these business provisions will apply to unrelated business income for many of the tax-exempt organizations, and they'll also apply to the for-profit ventures and the completely taxable entities that are on the call. So as has been discussed already, the corporate alternative minimum tax has been repealed, and the corporate tax rate was reduced from 35% to 21%. There's a new deduction for certain pass-through income, and we're going to talk about that for a little bit of our time today, as well as talking about expanded simplified accounting methods and changes to how property and equipment are expensed or depreciated. So with that, we've already discussed the corporate tax rate change, but the dividends received deduction also changed. And so the dividends received deduction has gone down if your ownership percentage is below 80%. And so that's going to affect a number of healthcare organizations. One of the key areas in the for-profit world that the IRS is going to focus on as a result of the tax legislation is reasonable compensation for highly compensated individuals. There continues to be an incentive to increase compensation to shareholder employees or owner employees inside of businesses, and healthcare is a very good example of that, as a way to reduce income that's subject to the double tax as a C corporation. So as a result, the IRS will continue what it has historically done, but will have a heightened focus on making sure that compensation is reasonable. There is a business interest deduction limitation. So for businesses with average gross receipts of more than $25 million, they may be subject to a limitation of their interest deduction. So what it means is that they can only deduct interest to the extent that it doesn't exceed 30% of adjusted taxable income. There's a few other adjustments to it, but it will impact organizations with large amounts of revenue who are highly leveraged, have a high degree of debt, but who report very little taxable income at the end of the year. There are some exceptions in real property trader businesses, and then there's an exemption for any businesses with average gross receipts of $25 million or less. There's simplified accounting methods for businesses with gross receipts of less than $25 million. They may use the cash method of accounting, which is simpler, and they are not required to track inventories, which is a requirement they used to be subject to. That means they're also exempt from the uniform capitalization rules. The accrual income recognition requires that an accrual method taxpayer needs to include an item into their income no later than it was taken into account as revenue on financial statements. Those financial statements can be publicly submitted financial statements for SEC registrants, but it also applies to certified audited financial statements and financial statements that are provided to federal and state governments or agencies, which is common in healthcare. And so because rules for GAAP, generally accepted accounting principle revenue recognition for these financial statements, often accelerates recognition of income, where some even accrual method tax filers defer the recognition of income. It brings those two into parity. Bonus depreciation has been increased to 100% of qualified property placed in service after September 27th, but before 2023. There's some significant changes to bonus depreciation. Under the old rules, you could deduct up to 50% only for new property, not just new to the organization, but a brand new, freshly minted piece of equipment, piece of furniture, but had to be a brand new piece of property in order to qualify. Under the new rules, it can be both new or used property, and you can write off up to 100%. Beginning in 2023, there is still bonus depreciation, but it starts to phase out. It reduces by 20% each year beginning in 2023 until the year 2027 when there's no further bonus depreciation. What this can mean for a transaction is that when acquiring another taxable entity or when acquiring another business, you can take all of the equipment and furniture and improvements that that organization has done, and it may be qualified bonus depreciable property under the new rules. So up through 2022, you can potentially write off the entire purchase price that's allocated to tangible property. There is a problem with the law. Under the old law, there was something called qualified improvement property. It was often called qualified leasehold improvement property. There were separate categories for restaurant and retail improvement properties. That's all been consolidated into one item called qualified improvement property. The law intended, and we can tell this from the House and the Senate versions and then the conference and committee reports, the law clearly intended for this qualified improvement property to be a 15-year recovery item property. It means you can take bonus depreciation on it. However, I kid you not, there's a typo in the final version of the law that President Trump signed. So the law actually doesn't allow that. So for qualified improvement property, which includes a lot of leasehold improvements, they may not qualify for bonus depreciation unless corrective legislation is passed. There's currently efforts to pass that corrective legislation, so there's some hope that it will be done. The way the law is written, it does qualify for bonus depreciation if it was placed in service between September 27th, 2017 and December 31st, 2017. But for items placed in service beginning in 2018, unless there's corrective action taken, it would not qualify for the 15-year recovery property and would be depreciated over a longer period of time and not eligible for bonus depreciation. Section 179 allows the deduction of what would normally be capital expenditures, but targets organizations that don't have large capital expenditures year to year. So it phases out under the old law once expenditures had exceeded $2 million. So under the new rules, you can expense up to $1 million, and it phases out once your capital expenditures for the year exceed $2.5 million. Now, you can take Section 179 expense on that qualified improvement property, but they also expanded it to be eligible for certain real property improvements, specifically roofs, heating, ventilation, and air conditioning property. So they've expanded what can be included here. Like-kind of exchanges now only apply to real property not held primarily for sale. A few tax planning opportunities, particularly for C corporations, would be cost segregation studies on large improvement projects. This can be done both on current projects and on projects that were placed in service in previous years. The tax strategy is that a cost segregation study will go through a building and the improvements that were placed in that building and break out its component parts so that they can be depreciated more quickly. It accelerates depreciation deductions. Since the tax rates have changed, if you can accelerate depreciation deductions into the 2017 tax year, that's reducing taxable income that's subject to the 35% tax, so there's a larger benefit. Whereas if you waited until the 2018 tax year to take those deductions, you still get the deduction, but it's offsetting taxable income being taxed at the 21% tax rate. This is a very narrow window and requires jumping on the opportunity as quickly as possible. You can also look at, as we discussed with bonus depreciation, going through asset acquisitions that happened in the final quarter of 2017 and looking at potential acquisitions that are coming up you may want to revisit in your estimates of the tax impact of those acquisitions, your ability to write off the tangible equipment and furnishings that were purchased. The depreciation, or amortization of goodwill remains unchanged. Research and development expenditures have changed. Beginning in 2022, research and development expenditures need to be capitalized and amortized ratably over 5 years. So if you think about that from the government's perspective, it takes the R&D budget for organizations across the country, and it means they can only deduct 1/5 of that budget in 2022. And then the following year, they're able to deduct 2/5 because they're able to deduct the 20% from the previous year plus 20% of the current year, and on it goes until after 5 years they're having normal research and development annual deductions. Again, it's a bit of a hassle, but it creates a one-time revenue-generating increase to the government, and it's part of how the Republican Congress was able to get the price tag for the reform under $1.5 trillion. If the reform price tag was over $1.5 trillion due to parliamentary rules, the Senate would not have been able to pass it with a mere majority vote. They would have needed at least 60 votes to pass the legislation. So it's really done for an accounting and budgeting reason, but for organizations that spend a lot of money on research and development, they should plan for this change. If you have research conducted outside the United States, it's amortized over 15 years. The pass-through income deduction is probably the most talked about area of tax reform in general. What it does is it allows organizations that have flow-through income have up to 20% of that income written off. So if you had K-1 income from that flow-through organization and the K-1 income was $100,000, you would only pay tax on $80,000 if you qualify. Here's the things that you need to watch out for. It only applies at the individual level. So it applies to business income, qualified business income, and flow-through entities, but the deduction itself takes place on an individual's 1040. So if you have investments in limited liability companies, partnerships, S corporations, and limited partnerships, and you are a C corporation or a tax-exempt entity, you won't receive this deduction. But if you have interests and you're an individual in those entities, you will, or you potentially will receive this deduction. The reason why I mention it on this call, even if you're not, if your ownership interest in these flow-through entities is as a C corporation or a tax-exempt entity, if you have partners, for example, a surgery center where a hospital may own 50% of the surgery center and individual physicians may own the other 50%, the individual physicians are going to have a big tax benefit depending on how the organization is structured. And I think it's important to be aware that your individual partners who are investing with you may have some significant economic incentives to revisit how some of these organizations are structured. So it applies to partnerships, limited liability companies, S corporations, and sole proprietors. It does not include K-1 income amounts intended to be compensation, and it's subject to a number of limitations. I'm not going to go through everything on this slide, but one of the important limitations is that this does not include income from specified service, trade, or business income. For those on this call, healthcare service income was specifically listed as not being qualified for this deduction. But that raises an interesting question. What is healthcare services income? And so some things to consider. Many organizations sell products as part of their medical services. There's also IRS guidance on what constitutes separate activities that we have to look at. And you have to look, and this is the IRS's perspective. The IRS has issued some limited guidance here. The IRS is interested to what extent an activity is connected with the diagnosis, treatment, and personal services of the provider. So some of the healthcare businesses that will be impacted here and will have strong economic interests in how the IRS carves out these rules will be labs, surgery centers, diagnostic imaging centers, and long-term care. For example, diagnostic imaging centers were at the center of a IRS ruling shortly after the tax reform law was passed, where the IRS determined that in this one particular case, the diagnostic imaging center was not providing healthcare services because it was not providing anything related to the diagnosis or treatment. It was receiving information, doing a test, and forwarding that information to healthcare providers, but the healthcare providers were the ones doing the formal diagnosis, and there was no coordination on treatment plans. Long-term care is an interesting one simply because it's a mixture of real estate, healthcare services, and food services. And so how it breaks out its income so that some of that income may qualify for this up to 20% business deduction is important. There are some allowance, even if you're a healthcare services organization, if the individual investor's taxable income is below $315,000 for those who are married filing jointly, or 1/2 of that amount for all other filers. This is a very busy slide, and I left it in here for your reference in case you would like to go back and look at how the various limitations on the qualified business income deduction work. There's a credit for paid leave under the new tax law, and so it allows organizations to take a credit of between 12.5% and 25% of an employee's wages paid to them while they were on a qualified family or medical leave. It requires that there be a written policy allowing at least 2 weeks of annual leave. It needs to be leave that's paid for by the organization, not by the state or local government. In California, for example, there's a Family Leave Act that allows the state will pay for part of the family leave, and so the state payments do not qualify for this. It's only available in 2018 and 2019. So if you think you might qualify for this, it's worth researching soon because it won't be around forever. One area that we're receiving a lot of questions about is entity selection. We won't go through all of the factors here for time reasons, but the question is whether it's better to be a flow-through entity versus a C corporation if you're a for-profit healthcare entity. And so the likelihood of a large sales price with significant goodwill is a factor. Generally, a C corporation is less advantageous in that respect. And whether the organization zeroes out its taxable income by paying its profits to individual shareholders as part of their compensation for those shareholders' wages versus organizations that retain their profits and reinvest it through buying other businesses or acquiring equipment, and also some of the administrative complexities that can come up with flow-through business entities. One thing I forgot to mention earlier is that the qualified business income deduction expires in 2026. There's a few other webcasts coming up from Moss Adams, or a few other webcasts that are available to watch on demand on the new tax law overview, the ASC 740 requirements, international tax, and entity choice, and a few other resources here from Moss Adams, but also the American Institute of Certified Public Accountants, the IRS, and other organizations that have great material on tax reform as well. And with that, I will pass the slides over to Emily.
All right, thank you. We have some time for questions. If you have a question for our presenters, you can enter that in the Q&A window and hit submit. I'll kick things off with our first question here. What form and frequency will the excise tax be reported on?
And I'll take that one. So as I'm sure you guys have heard a lot with this tax reform, we don't know. I would estimate that it's either going to get paid on Form 990T or it's going to get paid on Form 4720, which is often used to pay many of the excise taxes. That's the form that if there is the excise tax related to not completing your community health needs assessment, that's the form that excise tax is paid on. The question is, because it's the corporate tax rate that's applying, so that would make you think kind of more, well, that's kind of generally what's getting reported on the 990T. However, because they call it an excise tax, that's where it could be reported on the 4720. The frequency, it would probably be annually, and so it would be based off of the calendar year before. So if you have 1 year where it's going to qualify, or if you have 1 year where you're going to need to report it, then you would add it, or you would report it on the form. And then if the next year you didn't, then you wouldn't need to report it on that form.
Thank you. Our next question, regarding unrelated business tax, will alternative investments need to have subcategories depending on investment type?
So again, we're not quite certain. Generally, the IRS states that a partner in a partnership is considered to be conducting that activity. So from that, you could see where the IRS could have a position of saying, well, you have these different investments in different partnerships, therefore they're separate activities. However, we've also kind of considered that if the purpose of being invested in that partnership is for investment purposes, technically there could be a stance made that it's an investment activity overall, and therefore those alternative investments would be combined. Again, it's something that we're hoping that further clarification is going to come out on.
Thank you. How will the new corporate tax rate be applied for fiscal year-end entities?
So, and I think this was addressed earlier as well, but it's a blended rate. So for the pro rata portion of your taxable income that relates to the 2017 calendar year, it is taxed at the 35% rate, and the pro rata portion that relates to the calendar year days in 2018 will be taxed at the new 21% tax rate.
Thank you. What are some strategies you are seeing in response to the projected increase in uninsured patients?
One thing that organizations might want to consider is looking at their financial assistance policies. If you, to determine whether you're providing assistance for patients who qualify for subsidized Exchange or Affordable Care Act policies or state Medicaid policies, but choose to forego it. Since the penalty for not being insured has gone away, the Congressional Budget Office is expecting more people to choose not to be insured. And is that the population that you believe should be receiving financial assistance through your policies? That's the one area that I've seen discussions on. Colleen, I'm not sure if you've seen different discussions.
No, not yet.
All right, looks like we have time for a few more. When should we expect to have more clarity around fringe benefits specific to parking lots and on-site athletic facilities?
Again, we're not quite certain. Hopefully sometime soon. I know with the substantial change to the international taxes, with the change of the international taxes, there's become this big transition, one-time transition or toll tax. With that, the IRS is heavily focused on getting guidance out because payments need to be made by April 15th. So after that, after they get guidance on that and kind of worked out, they will probably start focusing on some of the other areas.
One of the challenging areas with this in particular is that it isn't, as Colleen mentioned, it's not at the top of the IRS's priority. They will address it, but I don't expect this to be part of the early regulations and guidance that they issue.
All right, probably can squeeze in one more question here. Do you have any guidance on the UBI related to on-premise fitness facilities?
Again, not really. They're with the parking, similar to the parking facility, they're also going to come out with regulations regarding what costs of the on-site athletic facilities will be considered in the taxability of it. Definitely you're looking at depreciation. However, it's, if it's within a building that you have overall depreciation in, how do you allocate that? It might be based on a square footage. Would it be based on use? So that also is something that we're waiting for additional guidance on, which I understand is frustrating. It's frustrating for us to not be able to provide more clarification on these.
Great, thank you. And I think that's just about all we have time for today. If you have any more questions for our presenters, please feel free to reach out to them directly. Thank you, Chris and Colleen, for a great presentation today. We certainly covered a lot of material. If you would like more resources on tax reform, you can visit our webpage on the slide deck and handouts widget, and you will also be able to access the other webcasts that Chris mentioned through there. And if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thanks for joining us, and we hope you'll join us again next time.